India, which is amongst the fastest growing economies in the world, has seen its private capital expenditure moving up. Is the recovery in private capex sustainable? And is it enough to take the heavy investment load off the government? Welcome to TOI Business Bytes. As Ranen Banerjee of PwC in India explains the role of private capex in the Indian economy. Talking about private capex, so how has private capex traditionally influenced GDP growth, employment in terms of its form, role, and impact on the economy?
See, private effect capex, of course, has to come in because the in the entire capex in a country, uh, the government has in India traditionally government capex has been higher, and in the share of capex because obviously the size of government and the government pump priming and the government budget spending on capex is very high. But the capex that comes from private sector is actually more job generating because it is not only the large industries, but it is also the small and medium enterprises that do capex, and from that, a large number of job generation happens. So, from that perspective, I think job creation, employment, and then consequently the incomes and consumption that get impacted through private capex. So, private capex is absolutely important, and we cannot always be uh, depending on the pump priming from government. But obviously, given the situation in the past year, we have been having higher government capex, and the government has had more availability of public finances because of the robust tax collections. So, and it was also a need of the hour because post-COVID, there was nervousness in the private sector to invest. So, there
Right.
was a need for the government to invest.
Okay, but coming to cycle right now, a lot of people are now saying that private capex is finally picking up. So what was holding it back till now, and are we really moving beyond the green shoot stage?
So, I think the key reason for the private capex being not picking up steam were two things. One is that the capacity utilizations were low. So
Right.
capacity utilizations were under 70% or under 70%. So that was one reason. Second, of course, is there was nervousness in the resilience of demand in various industries, given the headwinds, the economic headwinds, the geopolitical headwinds that the economy was facing, and also the inflation, the high inflation, and its impact on household income, and consequently the consumption. So therefore, there was nervousness and uncertainty in the on the demand side of it, and of course on the capacity utilization side of it, the capacity utilizations were lower. Therefore, there was no need to invest. So there, and that was holding back the investment.
Okay, Ken, but if we were to do a deep dive into this private capex, is it spread across industries, states, or other, investments only big ticket sizes?
So if we look at the investment, and this is, I was looking at the data from CMI on CAPEX, and these are project announcements, and these are not actual investments, but project investment announcements. And I
Right.
was looking at it even for the last 2 years. See and especially in this year, FY24, the majority of the investments are concentrated in two areas. And when
Hmm.
I say majority, it is almost 80% of the project announcements. Uh, about 60% are the airlines, the aircraft orders. Now that capex is the announcements are related to that, and
Right.
about 20% in energy sector projects, renewable energy and other energy projects. So 80% of the investment announcements are in these two areas. So therefore, it's a high concentration, and in these two particular areas where the investments are coming. That's the challenge that we have. That it is not yet very broad based.
Okay. What can we do to make it broad based, and what is the biggest risk to this revival?
So I think see one thing that could also be in the minds of say actual private capex hitting the ground is that the borrowing costs are currently again going up, and we are at the peak of the interest rate cycle. We all know that India at least has reached the peak, and most of the other central banks more or less have indicated that they have reached the peak. So we are at the highest point of the interest rate cycle, and we expect this interest rate cycle to again reverse in maybe 3 quarters or 4 quarters. So if means while the capex announcements can be there now, the planning can be there, but the actual borrowing and hitting the ground would be when the interest rate cycles start softening, because anybody who wants to borrow would like to wait. That is one, and two is that there is a still quite a bit of nervousness on, say, the rural incomes and the impact that the monsoons, the erratic monsoons have had on the crops and how the output will be. So there will be a weakness in the rural incomes, and also the generally speaking, the inflation is eating into the disposable incomes of households, and how much they will be willing to, or how much headroom they would be having to consume is also a concern. And if you look at even the household indebtedness, I think the debt levels at the households have gone up. If you look at the credit data, so all these factors are making private sector nervous about the growth in demand. While the private sector consumption is holding up, but will there be growth? Because if it is holding up, then there is capacity to serve that. Only when it grows is when there will be need for capacity addition, and that will lead to more capex actually hitting the ground. So I think the interest rate cycles and the nervousness on the demand growth are the two factors that are holding it back.
Okay, but from a government standpoint, what are the kind of reforms that can be introduced so that the private capex, continues to show some signs of revival as well? Because at the end of the day, as you said, that the government capex is something that has been a major contributor to growth till now. But how do we take that burden off the government?
Miss, at this stage, the government actually can do very little, because the demand growth is impacted by factors which is actually beyond the control of the government. Because inflation, we know, is supply side, and it is and a lot of food inflation, food related inflation. The government is trying to take steps to contain the inflation. So if the inflation controlling steps that are being taken, see those yield results, and unfortunately, the oil prices, global crude oil prices, have gone up very, very significantly, and that is also constraining the government's ability to fight inflation from the supply side. So I think there except for helping with the ease of doing business and the constraints that businesses have, the free paying the suppliers, because if the government is doing so much of capex, then there is a lot of projects that private sector is doing for the government, and paying those suppliers on time, paying the SMEs on time, will lead to lesser working capital requirements for the businesses. And if the working capital requirements are lesser, then the borrowing cost, of course, of that will be lesser, and maybe the businesses would start thinking of undertaking private capex at this stage. But I believe that the conditions are ripe for private sector capex to take off, because if the interest rate cycles are going to soften over in the next 3 to 4 quarters, and the bank balance sheets are strong, and the balance sheets of private sector are deleveraged to a great extent, it should help in the private sector capex take off as soon as the clouds of economic uncertainty recede a bit.